My name is Matt Hernandez, part of the Tom Hernandez and Associates team right here in the LA and San Fernando Valley, and we get calls and emails from people just like you looking to relocate to the area, and we absolutely love it when you reach out. So if you could, shoot us a text, send us an email, give us a call, and we'd be more than happy to make that transition as smooth as possible for you guys. So in today's video, we sat down with a tax preparer where we're gonna go over everything you need to know before filing your taxes, so stay tuned.
Everybody's coming in. This is awesome. Everybody, thank you for joining us here. This is Victoria. Victoria, why don't you introduce yourself and tell us a little bit about yourself? Yeah.
Hi guys, my name is Viktoria Khusit, and something happened to my camera, as always, So you have to look at my picture. At least you guys can hear me. I am doing taxes for about 20 years now. I am enrolled agent. And I do some real estate for fun, and Tom is my coach and my mentor. And again, I love doing taxes. I have my own company where I do prepare taxes for individuals. And I also work with Intuit on the TurboTax side. And I work internally. I do not work with the clients. I coach and teach experts.
Love it. Just trying to make you a co-host here, so hopefully you might pop up. So Victoria, today, thank you for everybody for joining us today. If everybody could kind of stay muted, we are going to do our best to kind of go through some preloaded questions that we have. At the end of this, you will have an opportunity to kind of ask any questions that maybe we didn't get answered or that you've been hoping to always want to know from a tax preparer. So today, tell us, Victoria, do we have to file taxes? Is there any way out of taxes?
Yes, there is a way out of taxes. That's called jail.
It's called jail.
You have to file taxes. Even if you owe a balance due in the end and you don't have money to pay it when you're filing, please still file and then work with IRS on a payment plan. Because when you don't file, you will pay a penalty for not filing your taxes, and then a penalty for failing to pay your balance due, plus an interest on the amount for the month you did not pay. So just by filing and letting IRS know that, yes, I filed, I know I owe this amount, you saving yourself about $300 in penalties.
Wow. So there is a one-time penalty that you pay for not filing your taxes. And then there's a interest payment that you have to make for the money that you didn't pay.
Absolutely. Yes.
Got you. So the rule is definitely file tax returns.
Yes.
Is there a minimum amount of money that you have to make? I heard like if you make less than $12,000, like you're exempt from filing taxes. Is that true?
Yeah, right. It's an urban myth. No, that's not true. If you're making anything over $600, you have to report. You're not going to pay tax on it, but you have to report it. So, and what people a lot get confused about, the $12,000, that's if you're a single person, you have a standard deduction. Everybody have a standard deduction, but the minimum amount is for a single person who filing as a single, it's $12,500, and it's deducted out of your income. So what people thinking, okay, I made $10,000, my standard deduction is $12,000. So I am minus $2,000. I don't have any income. I don't have to pay tax. However, if you're W-2 employees, that's true for you. But if you pay the income tax during a year on your W-2, you want to file a tax return so you get the taxes back. And then you probably will be qualified for earned income credit and some other credits. If you are self-employed and you 1099 or you're a cash vendor and you don't get a W-2, You absolutely have to file because you will have to pay taxes. So short answer is everything over $600 you have to report and file a tax return.
Man, that's like barely making any money and they want to get their taxes on us, huh?
Well, it's not that you will pay tax, but you will report it.
Gotcha. And let me ask you, a lot of people talk about forming an LLC, especially us agents being in real estate. We always talk about an LLC. Is that like a crucial thing? Are there any real benefits to an LLC regarding income taxes?
Oh, absolutely. I love you guys when you come to me and you bring in your LLCs. You know why? Because I charge you. And you have to have a specific tax return file for your LLC or for your Inc. And it costs more than your individual tax return because it just is. I love those clients. Now, if you're asking me for advice before you set up one, there is no tax benefit. You will have to pay about $500 to organize your LLC. You will have to pay $800 every year for having LLC in California. You will have to file little returns with, again, the Secretary of State, like statement of information every year that cost about $25. And then you will come to me and pay me hefty amount for preparing your LLC return. However, there is really no tax benefit for having, if you're a single member, there is no really tax benefit of having LLC. If you have a multiple partners, then yes, you want to have some sort of a company, because in the company you will divide how much you guys put in, what is your profit, who gets which percentage. It gets cleaner and easier. But if you just one person, it's disregarded entity in the tax laws, and it will just flow into your personal tax return. So save yourself some money. If you're looking for tax benefits, there is no tax benefit in LLC.
So I always thought that the LLC, like I'm a real estate agent. I make 20 grand a month on commissions, but I funnel that money into my LLC, and then I pay myself $5,000 a month, so that on my personal tax returns, it looks like I made, $35,000, $60,000 a year. And then all that other money got to stood in my LLC. So what you're saying is I can do that. I can pay myself $5,000 a month, but that difference that still stays in that LLC is still going to come back to me on my tax return.
There is nothing stays in LLC. Everything goes into your personal tax return. It comes as a K1.
As a K1. Got you.
Yeah.
So then the only real advantage to an LLC for like a real estate agent or somebody who's in self-employed in business might be as for legal purposes, like, hey, if they sue me, they're suing the LLC that has nothing. They're not suing me as a person.
You are funny. Yes. They will sue you as a person. They live in California, right?
Yeah.
So it seems like in our state, everything under the same umbrella. But yes, you will have a LLC for legal purposes, but not really for tax purposes.
Gotcha.
Unless you really want to be that fancy person that has an LLC and does everything through LLC and, then, yeah, but it's just a choice.
Gotcha.
Yeah.
Now, what about, like, I always heard of people talking about, I've got a Nevada corporation or a Nevada LLC, so we don't have state taxes or whatever they say that their benefit of that. Can I set up an out-of-state LLC and like take advantage of being in a state that doesn't have income tax or something like that?
Absolutely. You can set up your LLC in whatever state you want. However, if you live in California, you have to register your LLC as doing business in California as well on Secretary of State and pay California taxes. So what is going to happen, you're going to pay your federal, because you have to regardless, right? You're going to pay California taxes. You're going to file, And then you will have to pay fees, whatever yearly fees for your LLC in whatever state you organize. You will hear it a lot that what you just said people do, and they pretend not to pay California taxes. But again, if you're gonna go to a tax professional, nobody's gonna sign your return because it's fraudulent.
So I can create an LLC in, let's say, Nevada, but the minute I sell a property or earn a commission in California, because I sold a house in Studio City, that money that I generated for that sale in Studio City, or that income I earned, belongs to California. I can't funnel that back out of state is kind of the idea, correct?
No, and quite honestly, you can go to Nevada and sell it in Nevada, but if your primary office and place of living in California, you have to pay taxes on that income in California. California tax worldwide income.
Gotcha.
So it doesn't matter where you made it. As long as you live here, there is a tax return.
Kelly has a great question she just put on the chat here, and she says, what about an LLC and an S corporation? Is there a difference, or can you put them together? Or talk to me about that.
Well, there is, you can have an LLC, and if you're a single member, it's just you, it's called disregard entity for the tax purposes. What it means, you're not gonna have a separate tax return. You're just gonna have a name, Kelly LLC, but it's all gonna flow and it's all gonna be done on your personal tax return. You can elect to be treated as a S corporation. So your LLC, it still says Kelly LLC, but now it will be treated as an S corp, and it will require a separate tax return. So you no longer will be doing everything on your individual tax return. You're going to have two tax returns. And now, because it's an S corp, you require to pay yourself a salary on a W-2. You require. If with LLC you can escape that, as an owner of S corp, you require to pay yourself a reasonable salary. And I mean reasonable salary. So if your commissions, your gross sales are about $100,000, paying yourself $10,000 in a W-2 is not reasonable.
Got you. So there's really not a good advantage to being an S corp then, because now you're going to pay yourself a W-2, and now you got to write yourself out. I guess you're paying yourself I know, like for me, if I hire in a real estate assistant, I got a W-2 that person, and now I'm responsible for paying half of the taxes for her. I deduct, and then as a business owner, I got to pay some of her taxes. So I'm kind of paying myself twice, no, or charging myself as an S corp. That makes sense.
Kind of, yes. When you do it to yourself, yes. But it's tax deductible. It's and idea is that you're growing. So if you're growing, at some point you do want to become an entity, because it becomes cleaner than just being Tom Hernandez. Gotcha. So I got another question from Julie. Julie says, what happens if you get money in California and you do not tax in California when the LLC is out of state? Can you explain the benefits of an LLC? You get taxed in California. You do get taxed in California. You do get. Even if your LLC is in Nevada that does not have a state tax, because you live in California, you personally. You live in California. Julie, did I ask that right? Do you want to unmute and confirm that was your question?
Two separate questions. So if you, like you were explaining a couple minutes ago, if you have a Nevada LLC and you work in California, receive money in California, you're supposed to be paying tax in California. If you don't pay tax in California, what happens?
Ooh.
Oh, you get, nothing happens until you get audited. And when you get, so it's basically you playing a game, until somebody catch you.
And okay, and then the next question is, if there's no benefit to LLC other than ownership, what is the benefit of the, like, give us a scenario why you would do an LLC? Like, is an LLC have an operating agreement? And then how is that is that, I don't know if that's the correct term, but if there is a benefit to LLC and it's an operating agreement, how do you create that? Like, what do you do to do that? It's only for ownership?
So operating agreement, that would be legal questions, but operating agreements, you can pull one online. Just Google operating agreement and you can pull a standard one. And it usually talks about how your business is set up, how many stocks you have, who's the owners, who signs your checks, do you have any other partners, and stuff, who gets what percentage if you have a partnership. The benefit of LLC would be a legal benefit, just in case somebody wants to sue you. And if you've done all your paperwork correctly, supposedly they can go only after LLC. They cannot go after Julie and everything else that you own. If you don't have an LLC, then everything that you own is up for grabs.
Got you. So really the benefit of an LLC is if you're doing business with multiple people as a partner and you want to kind of have a shell in which you guys all operate under, and then you can divvy up the money or the profits according to the agreement of the LLC. Correct?
Yeah.
Gotcha.
And again, if you single, there is a legal reasons, not really a tax. Like if you're trying to get an LLC to escape a tax, it's not going to help you. You're just going to pay even more.
Gotcha. Sounds good. Yadeka's got a question in here, and it says, if you receive money as a gift, you need to report it. How much money are you talking about, Deka? You giving money away? I could be a family member if you're giving some money away, man. What are your thoughts on that?
So there is rules. And it all depends what money. If it's cash, forget about it. You're not reporting it anywhere. If it's, let's just say somebody sold a home and in escrow, they saying, okay, your mom sold the home and she's saying, okay, I'm gifting you this amount of money. There is a check. There is a separate tax return. Basically, all in each of us, we have a lifetime gift exemption. It's about $1 million. What it means, I can give Tom up to $1 million as a gift during my lifetime, as long as I disclose it on a tax return and Tom discloses on his return that I gave him this money as a gift. And we're all good.
And we don't have to pay tax on that money?
No.
Gotcha.
If it's over $1 million, over that exemption, then it becomes taxable.
Gotcha. And then Julie came back with taxes versus an inheritance. What do you mean, Julie?
So if you take that exact scenario, let's say mom has a house that's worth, let's say 300,000, just to make it easy. And she goes into, or let's say it's worth 400,000. She goes into escrow. She has 3 kids and she wants to give this one $100,000 gift, that one $100,000 gift, the third one $100,000 gift, and keep 100 for herself. And you have to pay capital gains. Does she avoid paying capital gains on that 300 gift money to those each persons?
Ooh,
I know that the kids will not pay anything. And
she pays on her only 100,000.
I believe so. I don't want to say 100% because those tax returns do not come up very often that I know on top of my head. But I believe so, because I had exactly the same situation last year when the lady bought a home at like 100,000 and she sold it right now at 600, and she gave, basically her son bought a home for like 200,000, right? But the value of the home was 600. So 400 difference she gifted him as a gift. he basically didn't pay for it. And she did not pay any tax because we did the gift exemption return for her, for him. And we just reported it that she gave it a gift and he accepted the gift. And this is social securities and amounts. And that was it.
So for the person giving the money, based upon what you know and what you're saying, that person can give $400,000 and deduct that from the profit or the capital gains that she might have had paid on that, and kind of saved herself some money from giving that to the IRS.
That's how it looked like. But don't hold me to that.
Okay. As best as you know, as of today, who knows what happens tomorrow in our tax system. I love it. Good. All right. Well, keep those questions coming if you have. My next question to you that I had that I've always just racked my brain out, because, we're talking with clients all the time, and, so-and-so's in a 20% tax bracket and 15%. I never know what to quote as a tax bracket. How are tax brackets even determined? Like, is it like the less money you make, the better, or how? Talk to me about that. Yeah.
So tax brackets. We have a lot of tax brackets. And when you guys look at your tax return, you're going to see effective tax rate and marginal tax rate. Never pay attention to marginal tax rate. You get what you pay an effective tax rate. And the way it's calculated, that it's a scale. It's a graduate scale. So when you hear that somebody says, I'm in a 37% rate, that does not mean that they take their $500,000, calculate 37%, and that's the tax they pay. The way it works, that minimum tax percentage is 10%. And 10% is being taxed on income up to about $9,000. So everybody pays 10%. And then from 9,000 to about 42,000, it's 12%. So if you're making 42,000, you're paying first 10% on the first 9,000, and then you're paying 12% on the rest until 42. And then it goes up to 22% from 40 to 86, and up and up and up. So everybody who makes over $523,000 on the amount, above, will pay 37%. So it's gradual. You pay a percentage on certain amount of income. Does it make sense?
Yeah. So it's kind of a sliding scale.
Yes.
Gotcha. And that sliding scale goes up into what'd you say, 542,000?
523. So anybody's making 523,000 and up will pay 37% on that up amount.
Gotcha.
So let's just say if you're making $1 million, you will pay 37% on almost $500,000.
Gotcha.
But not on $1 million.
Gotcha. So, a lot of times we're talking to clients, and I think probably a lot of us agents have this question, and we talk about like a client selling their house. Like Yadeka, I know he's one of them. He's one of my clients. We're selling one of his properties, and he's selling it for this price, but he bought it for this price. And we look at the difference of like what he, how do you say, what he's going to pay gains on? What does he pay tax on? And, I told him, well, you have your cost that you acquired the property for. I'm just going to say $300,000. And then, you spent $10,000 to buy it. So that takes your floor to 310. And then, it costs you $10,000 in maintenance to maintain the property. That takes you to 320. We sell it for 600,000. You walked out with, I'm gonna say 550. So the difference between that 320 and the 550 is what you're taxed on in gains. Am I right? Is that how it works?
Right. Now there is an exemption that if it's a primary residence, right, you have 250 for a single person or up to 500 for a married couple if you lived in a home, if it was your primary residence. But if it was a vacation home, even vacation home works with that. But if it was third house, right, that you had in Nevada, you just had it, Then it's a capital gain, and capital gain percentage can be either 0, 10%, and actually, I'm sorry, 0, 15, or 20%. And it depends on your income. How much tax on capital gain you pay depends on your total income. So if you like making over 400,000, your total income, you will pay 20% on capital gains.
Okay, so there's not a sliding scale for that, like the personal income, right? So that particular money gets taxed differently than his personal W-2 income that he makes.
Yes, but how much percentage, is it at 0, is it at 15 or 20%, will depend on his total income.
Gotcha. That makes sense. Okay, good to know. Julie, up with another good one. Prop 19.
I cannot stand Prop 19. Don't even start me on that.
Well, what is Prop 19?
Julie, what is Prop 19?
Well, I just, I get the question all the time. Like, these people have so much equity in their home. They come to me like, I bought this for 100,000 20 years ago. It's worth 3 million. I don't want to go buy a $3 million house. So what do? Can I sell my house and take the basis of when I bought it for 100,000 to my next? Can I go buy 3 houses, or do I have to buy one for equal or greater? Can I buy 3 houses in place of the one that I don't need anymore because it's too big? And, I can question all day long, Tom.
It's a good question to have. And I mean, that speaks to the type of clients you have, I guess,
But I also get like, I don't want to sell. I don't want to sell this piece of land because I don't want to pay capital gains. So if I sell this and I go buy something, what do I do?
That's oh my God, what it's called, 1031 exchange. So if you
that I'm saying, but like if somebody really honestly, if they buy a house and they're in it for 30 or 40 years, and okay, let's say it's worth $1 million and they bought it for 100, and now they want to sell it, but they maybe they want to buy both their kids a house and give their kids a $500,000 gift off of the sale of the house. Like where does the 1031, not the 1031 exchange, because it's a primary residence. Can you do that? Do you pay tax on purchase a primary resident? No. If you're selling your single family and you buy a single family, if you go from 100,000 purchase 30 years ago and you buy something for 500,000 today, and then you have an extra 500,000, you're going to buy a second home. How does the tax work for that? So you're buying 2 for 1.
Well, what does Prop 19 say? Victoria, can you help us with that?
Yeah, I am actually looking it up. So Proposition 19 is a home protection for seniors, severely disabled families, and victims of wildfire and natural disaster. So I don't hate this one. I'm sorry. I was thinking maybe Prop 17, what they did when they removed, or maybe that's the one when the property taxes got removed for properties. You know what? Let's come back to this one.
Okay, we'll come back to that one. Hey, Yadeka has a question on how does depreciation work on a property?
It gets depreciated over 27 and a half years. And every year you take a portion of it. And
Okay.
it has to be, it cannot be your primary residence.
So I have a rental property. I bought it for $300,000. I can depreciate a percentage every year up to 27 years?
Yep, you have to.
You have to.
Yes, you can, you may not take it, but when you sell your property, you will have to calculate and put that amount that you did not take and pay tax on it. So you better take it.
Got you. So what does that mean? So I buy a house for $300,000. It's an investment property. And now I get to depreciate the house saying that it's worth less?
No, when you depreciating, you're taking a credit.
Oh,
It's
got
a credit. Yes, what's happening? So when you depreciate any property, every year you allow the certain credit, certain percentage of the credit. So it's a credit on the papers. You might actually reduce your income. It will reduce. But when you sell it, you have to recapture all your depreciation that you took, and
Gotcha.
you have to add it back and pay tax on it.
So they're kind of giving you a break up front on this property, but when you go to sell it, you're going to have to pay it back.
Yes.
Gotcha. Okay, that makes sense. I hope that answers your question, Decca. Let's talk about flipping houses. I hear you see all these stories on these guys that flip houses, and Joe bought a house for $300,000 and sold it for $600,000. Joe's profit was $300,000, and you're like, I'm watching that TV program, going, "Come on, that's not true." That guy he's got capital gains tax on that house, and what does he do with all that stuff like that? And he spent $100,000 in rehab. Do when you buy a flip or invest in a flip house, do you pay capital gains on every house that you flip?
You would want to pay capital gains. You would love to pay capital gains because 20% is the top amount of tax you can pay. No, you pay your ordinary income. So flipping houses is a business. So if you are really in business, when you do a few houses at a time, when you do a few houses, one house a year does not consider it flipping houses. We're talking people who in business of flipping houses. For them, that's a business, and they get taxed at ordinary rate. So if they made $530,000, they're gonna pay 37%.
Wow. Okay. So you're saying it would be awesome if these house flippers could only pay capital gains.
Yeah, they would only pay 20%.
Got you. So if I flipped, let's say 3 houses a year, and I'm going to get a 1099 from the escrow company saying I just sold each house for $1 million. It's then up for me to go and itemize what my profit was for each house. Let's say it was $200,000 on each house. Yeah. I would report that I made $600,000 in my business of flipping houses that year.
Yes.
Got you. Okay. Myra, I'll get to your question there at a little bit later on. I've got some other questions. I just want to make sure that I get to before we get too long, because I know I've got her for a short amount of time. I just want to make sure I get everything. What about W-2 employees?
What about them?
What can they write off?
They cannot write off anything. So W-2 people used to write off uniforms, used to be able to write off union dues, so like we have dues with NRA and MLS fees, those like dues. And if you W-2s, you would be able to deduct it. No longer the case. W-2 people cannot deduct anything. I get this question a lot. Due to COVID, we work from home. So I have to purchase a computer, I have to purchase a desk, I have to purchase the stuff to do my job, but I'm a W-2. What can I deduct? You cannot deduct anything.
Wow. So I remember I have a client and his W-2 said he made like $80,000. And then we got to the underwriter, and the underwriter looked at his tax returns and he had these quote unreimbursed expenses for like $12,000, and that cut his income. And now the guy doesn't qualify anymore. And we're trying to amend his tax returns. We're trying to amend his tax returns to say, oh, he's taking back those unreimbursed expenses. So there's no longer unreimbursed expenses for W-2 employees.
No longer.
Got you. I guess that's a good thing.
Well, not to your guy, right?
Yeah, right. Well, what about a W-2 employee with like a side hustle? I do. I teach CrossFit out of my garage, and I just happen to lose $4,000 a year in this. I buy a lot of equipment. Can I deduct that off my W-2 earnings?
You can. You would have a Schedule C on your tax return. It's for your self-employed business. The trick is with self-employed business, when you start it, you can be negative first 2 years. And then you have to turn up income, because if you don't, IRS gonna consider your business a hobby and disallow all your expenses. So the trick on that, first 2 years you lose, then a couple years you make money, and then you lose again.
Gotcha. Gotcha. So it is good for then a W-2 employee to try to have some type of side hustle out there where they might be able to claim a small gain or a small loss for a couple of years and then throw a year of profit in there.
Tom, that's not a good advice. Advice is that if you have a side business, you making money. You're not creating a business to escape taxation. That's called a tax evasion. And we're not teaching a tax evasion.
Scratch that. We don't want that after all. Okay, I got you. Thanks for the clarification. It sounded good. I mean, when I thought about it, it sounded great. You know, I have this side hustle that I lose money on. I'm a W-2 employee. I can write off a few bucks on it, but I guess that's right there in the thing. Bruce, I saw your question. I'll get to yours too. You know, as a real estate agent, what deductions are we allowed to make?
It's pretty much the same deduction as everybody is being self-employed. It's your portion of your cell phone, unless you have a dedicated line, portion of your internet, unless you have a dedicated line. Then all your dues, the ones that we pay to get access to MLS, all your dues if you're a member of National Association of Creators. So pretty much anything associated with that, anything associated with your promotional materials, saying like T-shirt, Tom is the best agent, you know, like all those, all your pens, all your printing materials, all your signs, and portion of your clothes. So with clothes, you need to be careful here. I do have a couple clients that, you know, they buy beautiful clothes and they claim it 100%. You know, it becomes questionable. If you never wear that suit outside your job, yes. But if you at least once wore it on some other event, it's not 100%. Make a portion of it, you know? And again, when you come in, if you're doing your taxes yourself or when you're going to a tax professional, think about it. When somebody looks at it, does it look legit? Can you really prove it? You know, and if you can, if you have all those shoes that have holes on their bottoms because you keep walking and knocking on the doors, absolutely take 100% cost of those shoes.
What about my car?
What about your car?
Can I write off
Can you deduct
my car
it?
payment? Is it better to lease a car or buy a car as a real estate agent or any business?
So again, it's up to you. It's up to your finances. It's how you feel comfortable with, what is your style. The way taxes work, that yes, you can deduct your car. There is two ways of doing it. You can either claim a standard mileage deduction, where you're gonna count your miles you drove where you're gonna count total miles driven during a year, and then miles driven for business, and you get, IRS basically gives you 58 cents per mile. And that includes depreciation for your car too, but just 58 cents per miles you driven. That's a standard deduction. And then there is nothing you do with your payment for the car here or gas. And then there is actual expenses. You still again calculate your total miles driven, total miles for business. That's how you determine what is the percentage you can claim of your car expenses you can claim. And right there, you will add all your gas, all your oil, car insurance, and a car payment, and take a percentage. As far as the car payment, if it's a lease, you can take a full amount of the lease and then find the percentage of business use. If it's a purchase, your purchase consists of principal and interest, right?
Yeah.
You can deduct only interest, not the principal. So if your interest usually what, like about 2,000 over 5 years?
Right.
So that's what you're gonna deduct.
Got you. So in some senses, for us that are driving a lot and stuff like that, a lease might be more beneficial in the ability to write off more of that expense in an owning of the car.
If you're driving a lot, standard deductions might be better, because if you have a lot of miles, it might be just bigger deduction.
Got you. Okay. Let's bounce back to what do we got here? There was one, I think Myra asked, this is, how can I complete an S Corp taxes myself? We went from doing a DBA, self-preparing every year, to being an S Corp. How do I prepare them? Is there a software I can download or a website?
Yes. Well, I don't want to promote anybody. I'm not paid for the promotion, right? We have to disclose that. The one that I know, TurboTax Sell, it's you cannot do it online. It's a CD or a download. You basically it's called Home and Business.
Okay.
I think it's Home and no, it's a business. It's a business software. Yeah, TurboTax Business that will prepare your 1120S.
Got you. Or you could just call Victoria and she can do it for you.
I can do that.
Plug. Yeah, got you. Bruce has a question. Says, when you renovate an income property, can you deduct as repairs? Bruce, you want to chime in a little bit there? Are you there, Bruce? I don't know if I'm reading that right, but I think he's trying to say, can you deduct the repairs on your renovation?
Yes, it depends. Depends what kind of repair you have. So if you have paint and just like there is a improvements and repairs. So improvements, you need to capitalize and depreciate, and the repairs you can just deduct. So if you have some paint, if you have little, you change your mirrors, you change light fixtures, yes, you can just deduct those. Now, if you change the kitchen, you have to depreciate it.
Got you. So he wrote in here necessary repairs. So I'm assuming he had a rental. You walk in, you find out the tenants beat it up, and you got to go in there and maybe overhaul the kitchen, like you said.
Yeah. So again, it depends. If you're gonna touch the kitchen or a bathroom, got the bathroom, that's a depreciation. That's a capital expense.
Got you. So you'll have to depreciate it
over I think like 5 years.
Got you. What are the most common mistakes people make as filing their tax returns?
So this one might be sound funny. This is for married couples. When you're married, you have two options to file. You file as a married filing jointly, and you pay tax on your joint income, or you file married filing separately, and you paying tax on your separate income, but you still married. What I've seen people do, especially lately now, when one of the spouses is unemployed and does not make any money, the other spouse files as a head of household and claiming the spouse as a dependent. So that's a no-no, and that does not work this way. But I've seen quite a few of those, enough to be like, well, they got this idea. So that's a no-no.
Okay.
Then another one is that, like we said, when people think that if they making under $12,000, they don't have to claim. I helped a lot of people with EDD unemployment, and people did file for unemployment, and then later ADD sent a letter saying, send us proof of income, right?
Yeah.
And this lady called me and she said, Vista, she says, I don't have anything. I said, okay, did you claim unemployment? And she said, yes. I said, on what basis? She said, well, I'm a hairdresser, but I made less than 11,000, so I didn't file a tax return. But she went and she reported to EDD that she did make money, but less. And I had to go into explanation again that, no, my dear, you have to report everything over $600.
Got you.
And another one, this is for people who have rental properties.
Uh-huh.
When they file, so rental properties on a tax return go on Schedule E. And on Schedule E, there is a question. Are you an active real estate agent or something like that, right? And people say, of course, are you active in real estate? Something like, and people say, of course I am, right? I have all these rental properties. I'm not an agent, right? But I'm involved, and they check mark, and they get, if it's losses, they get all these deductions. It's all beautiful and nice, and then the issues happening. That question, you can check mark. There is a rule for that. So you have to spend 750 hours a year actively participating in the real estate. When you break it by the day, it's only 2 hours a day. It seems like, it's not much, right?
Right.
But do you really spend 2 hours? And you have to document it, right? So it's not for real estate agents because you are an actively participating in real estate. You're already an agent. But for people who are not agents, who just have real estate, right? And they have to meet the 750 hours requirement.
Wow.
So, and people don't know, don't think about it, and
So, I mean, obviously there's no police out there policing me to say if I put my 2 hours, but there's got to be some common sense in there that you have enough properties or property management going on to where on average about 2 hours a day is spent in you conducting your real estate business.
So there is a policing. If you get, it's all question about, nobody cares until you get audited. And when you get audited, you have to have that book with your mileage. Where did you end? Why did you claim that miles? Where did you go? And that book, the one that says, this is what I did today. This is what I did yesterday. And it's annoying and nobody wants to do it. But I do have that book on my desk. And every time I had a call from my tenant, so I have to go and collect, remind them that it's a collection rate date.
Gotcha.
I put it in my book.
You logged it in your book.
Yeah.
You and I talked the other day and you said something that was really interesting. I wanted to bring it up was how far back can they go back to, like, when are you done where they ain't auditing that tax return no more? Like, sucker, I'm free of that year.
3 years.
3 years.
So if you file every year, and that's circling back to that balance due that you have, if you file, IRS has 3 years to go back and open your tax return. So every year you file, it's moving forward, right? So if you do not file, IRS has indefinite time to come and audit you and bill you.
Wow. But after so as long as I pay my taxes and I don't have a balance, after 3 years, those taxes are done and filed away. They're not coming back and auditing.
No, as long as you file, you don't have to pay. As long as you file and 3 years pass, they cannot open your tax return and say, hey, you owe us $3,000, but now we think you did a mistake and you owe us $10,000. It's still going to be $3,000.
Gotcha. What about renters? Can renters deduct anything? Is there anything for them? Any reason why they should be staying as renting?
If they self-employed, yeah, they can deduct their rent for portion of their rent and rental insurance and internet and gas and utilities. But being in California and with our prices, for rent and to buy a property, I would just say if they are qualified, just go and buy that property and pay yourself, make that equity in the property. And if you don't like it, sell it in a year and make some money that you can pull out and put into something else.
You know, when a lot of times when I talk to renters, I talk to them about, not only is the home building equity, but it's a form of a tax shelter, meaning that they can write off their property taxes and their interest and stuff like that. Am I correct when I tell clients that?
You're right. However, don't ever tell it to my husband. He was saying when we got married, and this is, we filed our first tax return, and he was like, "Oh my God, babe, what happened? Why do we owe money?" And I said, "Well, your W-2, my self-employed income, here we are, we owing money." And he said, I was always told, get married, buy a house, have a kid, you will never pay taxes. What happened? So, that might be true, what you're saying, that people can deduct mortgage and property taxes, but it all depends how much it is. Because on a tax return, we all get a standard deduction. Again, coming back to that, if you're single, to that $12,000. If you're married, it's like about $22,000. So if your mortgage and property tax is above that amount, then yes, you can deduct it. Otherwise, your standard deduction is bigger, and you will take a standard deduction.
Ah, got it. Interesting. Okay, I get that. So if let's say their interest that they're writing off is only $10,000 or $12,000, they're better off just taking their standard deduction.
Yes.
Gotcha. That makes sense. Okay. Which is better, a tax credit or a tax deduction?
Oh, those are fantastic and two different things. So tax deduction is money that's being deducted out of your income, and then you paying tax on what's left. Tax credit is the amount that's being deducted out of your tax liability. And there is two types of credits. There is a refundable credits and there is a non-refundable credits. So non-refundable credits, they will just go against your tax liability. And if your tax liability less, you're just gonna lose the rest of your credit. If it's a refundable credit, then you can get a refund.
So you're saying that if I have a credit and it's $3,000, but I only owe $2,000 and it's non-refundable, they're going to take the 2,000, I lose 1,000.
Yes.
But if it's refundable, they'll take the 2,000 and then they'll send me a check for 1,000.
Exactly. So
And
one of those credits is earned income credit. That's
Okay.
a refundable credit. So if you made $15,000, your tax gonna be about, you self-employed, right? And your tax is gonna be about, let's just say, $1,000. But you got an earned income credit that is $1,500. You're gonna get back $500.
Gotcha. So they're both good. There's no one better than the other.
Well, it's not like we can pick and choose. They are set by IRS, and you need to have certain qualifications to get those credits. And honestly, majority, if you're making money, you're not getting none of those. Not deductions, not credits.
Gotcha.
You just keep paying taxes.
Hey, what about self-employed, my meals and entertainment and stuff like that? Like, can I write that off?
Well, you can take me to lunch and we can talk about taxes, and you can write off that meal bill. But I like games too. You can take me to the game and we can talk, but that's just gonna be because you like me. You cannot deduct it.
So you mean like my season tickets to the Chargers, I can't deduct that because I take a client with me?
No, you cannot. And honestly, you couldn't deduct it before because it's not, you could have deduct only portion of it. You will have to divide to how many games you could have went and what is a portion of it. So not just whole amount and saying, oh, because you don't take in clients to every game.
Man, I was going to take you, Decca, to the Denver game, Charger Denver game. And I guess, if it's not a tax write-off, I'd rather take Nadia instead,
Yeah, just go enjoy.
Sorry, Decca. That's funny. But what about travel? I heard that like if you travel and I go look at some houses while I'm out in real estate or something like that, then I can write that vacation off as a business expense.
Oh, I wish you know how many vacations I could have deducted because
Come
you know
on.
I talk about taxes pretty much everywhere I go. So no, yes and no. Travel is deductible, and when you do have to travel for business, it is deductible. So let's just say if I speak in Nevada and I got invited to a conference and I'm gonna be talking about taxes, my trip will be deductible, my hotel will be deductible, and all my meals while I'm there. Going to look at the houses because you're on vacation and you figured that, let me pretend that I'm going to be looking at some houses. Maybe someday I'm going to get a client who wants to move here.
Yeah, in Hawaii, like they might want to move to Honolulu one day.
Yeah, when that day comes and you have a proper communication with your client where your client says, yes, I want to see, let's go set up those viewings, and your client flying with you or your client signing that paperwork, giving you authorization to look at the houses, then you can.
Okay, so if your Deca sends me an email and says, hey, I'm thinking about going to Hawaii, Tom, I think I need you to fly out there and go look at homes in July 17th to the 28th period, and I can document that he sent me that email, then I can take that trip and it's a business expense, right?
Come on. Don't put me on the spot.
All right.
Yeah.
I'm trying,
Right.
Victoria. Dang, man, I was close too. Okay, good. Victoria, we are just
wait. But if you go together and you do look, it might be possible.
All right. Sounds good. So if I take them to Denver then to go stay at my condo and we catch a Denver Bronco game, then that whole stuff is all write-offable because I took a client with me to go look at
No, your Denver stuff is your vacation home. It's
but we're going to go look at property out there.
The train left that station long time ago when you reported it as your vacation home.
Okay. All right. Oh, that's sale too, Deck. I guess we're not going to Denver either. We are exactly at about an hour. If anybody has any last minute questions that they want to add that I might have missed, let's get them out the way right now. Yeah, guys, you want to chime in or text me? We can work on that.
I'm sorry. I wanted to touch base a little bit on Proposition 19. So
okay. Yes.
Proposition 19 was when the property taxes would transfer for seniors would transfer to the new purchase, meaning that if they bought something for $100,000 and they pay tax on 100, right? And now they sell it at $1 million and buy something at $1 million, they can transfer their property taxes. That's what that Proposition 19 is about. A second part from that Proposition 19 was that I was very upset about it, that if you have a rental property, and so let's just say my parents bought a rental property. They have a house, right? They passed away and I get that house. But I have my property, right? I have my primary residence. I'm not going to make it my primary residence and I'm going to turn it into rental. Now my property tax is going to increase to a fair market value of the property. And so that's what a lot of people, that's what a lot of people got upset over, because like I have a few clients who bought houses in Lake Arrowhead, like 50 years ago. They paid $20,000 for those houses. Their property taxes are very tiny. And now the parents at this age where they're 90 plus, so the kids now, once they acquire those properties, will have to readjust their property taxes. And that's what Proposition 19 did. I'm all for seniors to keep their property taxes low. Don't get me wrong. I'm all for that. But the second part upset me a lot.
So I guess Julie's question is can they take that and split that up to two properties? Could they go and
No.
sell and buy two? Because then one's going to become an income property, and
Yeah.
that second property will probably lose the tax.
Yeah.
Got you. Okay, good stuff. I don't see anything else in the chats. Anybody else want to unmute and ask a question? Going once, going twice, and sold. Victoria, thank you so much. Victoria, is there anything that you want to say to everybody that's on here, everybody that's on Facebook Live about taxes, about 2022, anything that closing thoughts as a tax preparer?
Just again, guys, always file your taxes. Don't miss your due dates. There is a due, if you have a company, double check your due dates because they start March 15, filing due dates for the companies, and then April 15. This year, I believe it's April 18 because it goes on the holiday 15 falls in. File your taxes. Even if you owe money, just file. Apply with IRS for your payment plan. If you cannot pay it at once, pay it in portions, but don't let it sit. IRS is not forgiving.
Oh, I think I have some bad memories etched in my brain from a couple of those audits that I know. And yes, this guy pays his taxes. Victoria, if anybody wanted to reach out to you and do business with you, you want to put in your text message or how we could get a hold of you or phone number, email?
I have a great YouTube channel that has all my information, and it has my email. You guys can reach out to me this way. It's you can put my name, Viktoria Khusit, and it's gonna come up, or it's VK Consult. I had a great logo behind me in Zoom that you guys could not see. It's VK Consulting LLC. I come up as well, and of course Tom. And you can reach out to him and he can get a hold of me. And I am open for any business. I will help any friend and client of Tom because he is my savior. Anytime I have a difficult real estate transaction, who do you think I call? I call Tom and I say, please help me.
Well, thank you for coming out. I know it was taking some time out of your day. Thank you to everybody that's really kind of sat in on this. This is an opportunity for me to give back to the community of real estate. I'm not promoting myself. I'm not just want to give an opportunity to everybody to hopefully learn something, get some value here. Victoria is amazing. She's super funny. She's super cool. Victoria, just in the message blog, put your YouTube page in there so people can kind of get it in the chat box real quick before we sign off. Yeah.
Mm-hmm.
Can you type that in there and send it out? So I think hopefully everybody can kind of see that in the message block. Okay, YouTube. It looks like www.youtube.com/c/c Viktoria Khusit, or Khusit, excuse me. The K is silent, guys. All right. Hey, thank you very much again. Blessings to everybody. Stay safe out there. And Erica, let's wrap this bad boy up. We're signing off, guys. Thank you, and we'll talk to you guys soon. Bye, everybody.
Okay, that wraps it up for today's video. Thank you so much for watching all the way through the end. Do me a favor, hit the like button, let YouTube know that you found some of our information useful, subscribe, hit that notification bell. That way you can be notified about what's going on in our current marketplace, and we can't wait to see you on the next video. Bye, guys.